Hello and welcome back to Chapter 7, Topic 1, Overview of FX Options Transaction. In the first part, we have studied the definition of FX options trading, its relevant terms, such as expiration, strike price, volume, holder, writer, European style and American style option. In this part, we will get into the details of option premium and differentiate between call options and put options. Premium is the essential term of options trading. An option premium is the price of an option contract. It is the sum of money that the holder pays the writer for the right to buy, or to sell, an amount of currency at a specific rate. We have studied that the holder is free to or not to exercise the right. The holder would exercise the right once he finds it profitable. If it is profitable for the holder, it will be loss-making for the writer. In other words, in an option contract, the profit of the holder is the loss of the writer. Thus, the premium is the highest income that the writer could receive in an option trade. For this reason, calculating option premiums is crucial. Option premiums are affected by many factors, such as strike price, contract term, style of option, interest rate of the currency, etc. Currently, options pricing is based on Black-Scholes model. Let's examine each of option premium factors. We will start with the relationship between option premiums and strike prices. Suppose there are two options. The first is to buy 100,000 US dollars at 23,000 VND per USD. The second is at 23,100 VND per USD. Both have the same expiration date. Which one would you prefer? Certainly the first one is the better, isn't it? Hence, its price, that is its premium, is higher. So, in case of an options to buy, the lower the strike price, the higher the premium. Conversely, in case of an options to sell, the higher the strike price, the higher the premium, since when selling, higher prices are better prices. We can conclude that the strike price of a call options is inversely proportional to the option premium. The call options contract which has lower strike price will has higher premium. The strike price of a put option is directly proportional to the option premium. The put options contract which has highest strike price will has higher premium. The contract term of an options contract, or the time until the options contract expiration date, also affects the premium. Because the longer this period is, the higher possibility that the exchange rate would unexpectedly change, and the fluctuations could be wilder. Therefore, an options contract having longer contract term tends to have higher premium to offset against the risks. Evidently, American-style options and European-style options will have different premiums. Since American-style options are more flexible, that means the holders have more advantages. They would have higher premiums than European style. Other factors could affect the premium that should be considered are the interest rate of the underlying currencies, the implied volatility of the exchange rates, etc. These factors will be taken into account while pricing the options, or calculating the premiums. Currently, option premiums are calculated using Black-Scholes model. The model was developed in 1973 by Professors Fisher Black and Myron Scholes. It was meant to price European-style options, and, at first, used for non-dividend paying stocks. Black-Scholes model was constructed under following assumptions. The interest rates of underlying currencies would not change during the contract term, and no differentiation between deposit and loan interest rates. No commissions and transaction costs. prices follow a log-normal distribution. The volatility of the market is constant over time. Then, according to Black-Scholes model, the options could be priced as following equation. Where SE is the European-style option premium, S is the spot's price, E is the strike price, T is the contract term, or the time until expiration, of which the unit is year. A and B are the risk-free continuous compounding interests of base currency and countercurrency respectively, of which the number of periods is infinite. E is the Napier's constant, approximately 2.71828. So, you have been introduced the Black-Scholes model used to pricing options contracts. Though the model has some limitations because some of the assumptions might not happen in reality, it is still used popularly to calculate option premiums since the margin of error is tolerable. If you are interested in this model, you are advised to do some extra reading in the textbook Foreign Exchange Trading of Associate Professor Dr. Wenmin Q. Next, we will scrutinize issues concerning call options and put options, American-style and European-style options. We have mentioned the terms call and put quite often lately when discussing options trading. So what are call and put? Call is an option giving the buyer, or the holder, the right to buy an amount of foreign currency at a specific exchange rate. Put is an option giving the buyer, or the holder, the right to sell an amount of foreign currency at a specific exchange rate. In a call option contract, to buy the right is named long call, and to sell the right is named short call. The buyer pays the seller for the right to buy an amount of foreign currency at a predetermined exchange rate. Once entering a call option contract, the holder would have the right to buy an amount of foreign currency at the exchange rate determined at transaction date, which is called the strike price. Simultaneously, the buyer has the duty to pay the seller a sum of money, called the premium. Then, depending on the situations of spot exchange rate on the market, the holder will choose what to do with the right. If the holder exercises the right, he will receive the amount of foreign currency as agreed in the contract from the writer after paying at the strike price. If the holder does not exercise the right, he will lose the premium. That is the only cost he has to pay in this case. This graph illustrates the profits or losses of a call options holder. The vertical axis shows profits or losses. The horizontal axis shows the spot's price when the contract is executed. Buying a call options, the holder has to pay the premium. This is the initial cost the holder has to spend. So it starts at this cost. On the expiration date of the contract, if the spot's price is less than the strike price, the holder will not execute the contract since he could buy the foreign currency at lower prices on the market. In this case, the costs of the contract is the premium. So, when the spot's prices are less than the strike price, the profits or losses of the holder is a line parallel with the horizontal axis at the premium level. On the expiration date of the contract, if the spot's price is more than the strike price, the holder will execute the contract since he could buy the foreign currency at strike prices lower than the market price. In this case, the holder would make a profit equals to the difference between the market price and the strike price after deducting the premium. Thus, when the market price is more than the strike price, the higher the market price is, the more profit the holder could get. So, When the spot's prices are more than the strike price, the line indicating the profits or losses of the holder will run upwards, showing that the holder could get infinite profits in case the spot price increase infinitely. The break-even point is the market price at which executing the contract could only help offset the premium that the holder has to pay. The profits or losses of a call option writer graph is inversely mirrored that of the holder. The maximum profit a call option writer is the premium when the holder does not exercise the right. Hence, when spot's prices are lower than the strike price, the writer's profit is aligned parallels to the horizontal axis at the premium level. When the holder exercises the right, that is when spot prices are higher than the strike price, the writer has to sell the underlying currency at the strike price lower than the market price and suffers losses. The writer's loss is equal to the holder's profits. Therefore, the market price is higher than the strike price. The higher the market price is, the more losses the writer has to bear. Similar to call options, to buy a put option is named long put. Long put holders have to pay the long put writers the premium for the rights to sell the amounts of foreign currencies at the strike prices determined on the contract dates. Put option holders will execute the contracts if they are profitable. That is when the spot's prices on the market are lower than the strike prices. In this case, the writers have to buy the currencies from the holders at the strike prices which are higher than the market prices. Conversely, if the market prices are higher than the strike prices, the holders will not execute the contracts. Instead, they will sell the currencies on the market where the prices are higher. So, who do you think would be the put option holders? They are who have incomes in foreign currencies and want to prevent the exchange rate fluctuation risks, for example, export companies. You can draw the profits or losses of put option holders and writers graphs the same ways you develop the graphs for call option holders and writers. In case of long put, the holder's initial cost is the premium, and his profit is infinite as long as the market price is lower than the strike price. In contrast, if the market price is higher than the strike price, the put holder will not execute the contract and lose only the premium. In case of short put, the profits of the holders are the losses of the writers. So, the graph of short put is opposite to of long put. Using graphs will help you easily imagine the profits and maximum costs that each participant in an option trade could gain or bear, so that you can consider the risk levels when using option contracts. We have just finished topic 1 of Chapter 7, Overview of Options Trading. Now you explain its definition and relating terms such as strike price, holder and writer, etc. You also be able to grasp the characteristics of option contracts, distinguish between European-style and American-style options, call options and put options. You too know how to price an option using Black-Scholes model, and have the general pictures of the profits or losses of options holders and writers. In the next session, you will experience options trading through exercises and practices. See you then.